In 1966, Buffalo Springfield sang a still popular song, "What's That Sound?" Although the lyrics were written almost 40 years ago, they seem to be quite consistent with what we are experiencing today. It's time we stop. Hey, what's that sound? Everybody look, what's going down? What a field day for the heat. Ooh, ooh, ooh. 1,000 people in the street. Ooh, ooh, ooh. Singing songs and they carrying signs. Ooh, ooh, ooh. Mostly say, hooray for our side. Ooh, ooh, ooh. It's time we stop. Hey, what's that sound? Everybody look, what's going down? Paranoia strikes deep. Into your life it will creep. It starts when you're always afraid. Step out of line, the men come and take you away. This song could have been written late this year. As we near the inauguration of President Donald Trump for his second term, there appear to be more changes about to be made in the personnel of the U.S. government than any time I can remember. I bring this up because what the financial markets like less than anything else is the unknown. Markets can adapt to expected bad or expected good, but when presented with unknowns that have not been quantified, institutional investors tend to go immediately into defense mode. In the case of 2025 and the new administration, the markets have been given the luxury of having seen how the president-elect has acted during a previous administration. Yet, as is well known, this president is far from predictable. There seems to be an overwhelming bias towards keeping the economy strong, dealing with immigration, and threatening tariffs to both our northern and southern neighbors, as well as our trading partners across the Atlantic. Hence, this week's title. It appears that the financial markets have clear skies ahead, but there could be some unforeseen storms on the horizon as the new administration takes new tacks globally. Stay the course. With less than 10 trading days left in 2024, we enter 2025 with the same stance toward U.S. equities that we have held for most of 2024. Large cap growth companies continue to lead on an absolute basis, bonds, cash, and international equities. The reason for our continued positive stance is that the pillars of the bull market remain intact. Disinflation, earnings acceleration, and broad participation by most sectors and leading stocks. At the same time, as we peer ahead, we are concerned that each of these pillars may fall by the wayside as they cannot continue in perpetuity. Shown here is a list of the targets for 2025 by various major research houses. Thomas Lee of Fundstrat actually believes that Santa Claus will come to Wall Street before year end and has set a target for year end of 6,300, basically another 5% in a 2-week period. This would be a wonderful Christmas present to all who are invested to participate in the current year-end leaders. But what I wanted to talk about most this week is what the statistics say for 2025. When I started to look at the stats, what I found was really quite amazing. 2025 shows a very strong first half, many seeing upwards of 7,000 on the S&P 500, a difficult third quarter, and a year-end rally. It is very difficult to posture on what will happen, but I do feel comfortable sharing what has happened in years past. One of my favorite research houses, Ned Davis Research, NDR, does a terrific job of marrying forecasting with objective historical analysis by featuring cycle composites. They average 3 historical price patterns: 1 year cycle, the 4-year cycle, post-election years for 2025, and the 10-year cycle, years ending in 5. I see this as history's view of what the year could look like. This is a graph of what could be expected should these 1, 4, and 10-year cycles hold true. I tend to hold more emphasis on the 4-year cycle as the 1 year is quite short and the 10-year tends to not really have enough data points. Since the 4-year corresponds to the election cycle as well, it allows me to drill down to expectations of the reignited Trump administration. I think this should get special attention as it could have been a surprise to Trump when he was elected in 2016. And in the surprise, he didn't have a particularly long relationship and knowledge of the many political people in his administration. This time, he has had 8 years to review, reflect, and build relationships with many party leaders. Trump's fiscal policies could drive economic growth, influence monetary policy, and be at the forefront of investors' minds. Second, the post-election year trend for a stronger first half and weaker second half aligns with possible reinvigorated inflation concerns and a bit slower earnings growth. What I was particularly surprised at was that according to NDR's cycle work, years ending in 5 shows are the strongest of the decade. These years ending in 5 have been the strongest in trend. This chart shows the entire 10-year decade cycle so that it can be seen what each of the 10 years tend to look like. While the 9 other years endure at least one extended period of decline or consolidation of a previous move, years ending in 5 have enjoyed almost uninterrupted rallies on average. Going all the way back to 1895, years ending in 5 have risen a mean of 20.7% and a median of 26.3%. Those averages far outpace second place, years ending in 8. Not only that, but these average returns have been positive 92.3% of the time. I find these to be really quite extraordinary statistics. The only exception was in 2015, when the S&P 500 did not exhibit the normally expected strength, and it was only down 0.7%. Not what I hoped for, but clearly not a big digestion. In asking why, I find that bear markets have been rare without the incidence of recessions. When there is no recession in the offing, markets find it difficult to be bearish. I will finish with the general trend of the cycle composite and the 4-year presidential cycle chart. I am showing this as it reflects the possible expectation of a strong first half, difficult Q3, and a bit stronger finish. I have circled this on this chart so that it is clear where I am focused in this explanation. It might be interesting to really go out on a limb and look at what could also be the expectation in 2026, far less friendly. The 2025 second half could carry into 2026 and will probably depend on if inflation continues to moderate or reverses higher, earnings growth continues to accelerate or decelerate, or another shock disrupts the rally. Bull markets do not die of old age. As always, please contact us if we may be of assistance.